Have you ever wondered where you truly stand financially compared to the rest of the country? Or perhaps you have felt unsure about what wealth milestones you should actually be aiming for at your current age. In this video, we are diving deep into the fascinating world of net worth classes in the United States, breaking down the actual numbers, from the median net worth of everyday households all the way to the top 1%. By looking at the latest data from the Federal Reserve Survey of Consumer Finances, we will explore the different wealth tiers ranging from the emerging and middle class brackets to high net worth individuals, providing you with clear, actionable benchmarks tailored to your age so that you can understand exactly where you rank today and what specific strategies you can implement to accelerate your wealth building. Part 1. Understanding the bottom tier and median net worth in the United States. Understanding the bottom tier and median net worth in the United States begins with examining the lowest wealth segments of the population, where many households find themselves in a negative net worth or low asset situation. For this segment of the population, wealth is often constrained by high levels of consumer debt, such as credit cards and student loans, alongside a lack of significant investment assets like real estate or retirement accounts. When evaluating this bottom tier, the figures show that households in this bracket frequently struggle to build an emergency fund, leaving them highly vulnerable to economic shocks. The median net worth for households under 35 years of age sits near $39,000, but for the bottom quartile, this number drops significantly or even falls into negative territory. This reality highlights the fundamental importance of prioritizing debt reduction and establishing a basic savings safety net before attempting to scale up to higher wealth brackets. Moving beyond the bottom tier brings us to the median net worth threshold, which represents the exact middle point of the United States wealth distribution. According to data from the Federal Reserve Survey of Consumer Finances, the median American household net worth stands at approximately $193,000 across all age groups, meaning half of the country has a higher net worth and half has a lower net worth. This median figure serves as the first major milestone for anyone seeking financial stability, as it typically reflects a household that owns a primary residence with equity, holds money in transactional deposits, and has accumulated an amount in retirement accounts. Reaching or exceeding this median level is a clear indicator that your wealth generation strategy is working and that you are successfully outpacing the baseline cost of living and inflation. To transition from the lower tiers and reach the median net worth level, you must focus on the primary drivers of the balance sheet. The most significant asset for this group is primary residence equity, followed closely by retirement savings, which together make up a substantial portion of the typical household wealth. You can take immediate action by consistently contributing a percentage of your monthly income to employer-sponsored retirement plans or index funds, and by aggressively paying down high-interest consumer debt. By shifting your focus away from depreciating assets and focusing on building equity in a home and compounding investments, you create the momentum required to exit the bottom tier and establish a solid median wealth foundation. Part 2. The middle-class wealth brackets and what they mean for the average earner. The middle-class wealth bracket represents the demographic that has moved past mere survival and is now actively building wealth through property and long-term investments. For the average earner, this bracket usually spans from $100,000 to around $500,000, depending largely on the individual age and career stage. Within this tier, a significant portion of the net worth is tied up in home equity and retirement funds, such as employer-sponsored 401k plans or individual retirement accounts. Households in this bracket typically earn a middle-class income, enabling them to cover basic living expenses while consistently investing a portion of their earnings. Understanding this tier helps the average earner identify whether they are accumulating wealth at an appropriate pace compared to their peers who have similar income levels. being part of the middle-class wealth bracket brings specific financial challenges and opportunities that every earner must navigate. One of the main challenges is the tendency to experience lifestyle inflation, where an increase in income leads to higher spending rather than increased savings. As middle-income earners see their salaries rise, there is often a temptation to upgrade homes, vehicles, or daily habits, which can easily stall wealth accumulation and trap families in a plateau. However, those who successfully manage their discretionary spending are able to leverage their income to acquire income-producing assets like dividend-paying stocks, exchange-traded funds, and real estate investment properties. This proactive approach ensures that the average earner transitions from relying solely on an active salary to generating passive growth and financial security. To move beyond the middle-class wealth bracket and step into the affluent tier, an average earner must focus on accelerating the growth rate of their net worth. This requires increasing the savings rate to at least 20% of gross income and aggressively diversifying the portfolio beyond just a primary residence. You can take actionable steps today by analyzing your current expenses to eliminate hidden costs and by redirecting those funds into high-yield savings accounts, broad market index funds, or continuous professional development that can increase your earning power. Building wealth in the middle class is not about having a massive windfall, but rather about the consistent execution of small, disciplined financial habits over a long period. Part 3. High net worth and affluent classes as you advance in your career. The affluent class and high net worth tier represent a significant leap in financial capability, typically comprising individuals whose net worth ranges from $1 million to $5 million. As professionals advance in their careers, reach executive positions, or scale successful businesses, their capacity to save and invest multiplies, allowing them to accumulate assets at an accelerated rate. In this wealth class, the primary source of wealth generation shifts from basic savings to complex asset portfolios, including equity in private businesses, multiple real estate holdings, and large taxable brokerage accounts. Understanding this tier requires looking beyond a standard retirement account and recognizing how compounding returns on a large capital base create a snowball effect, enabling individuals to generate more wealth purely from their investments than they do from their active labor. Moving into the high net worth category introduces a new level of financial complexity, requiring a shift in focus toward asset protection, tax efficiency, and estate planning. At this stage, individuals must deal with higher tax brackets, necessitating strategies such as utilizing municipal bonds, tax loss harvesting, and establishing trusts or holding companies to preserve generational wealth. Furthermore, diversification becomes paramount, as a substantial portion of the net worth might be tied up in a primary business or a single asset class. By diversifying into international markets, commercial real estate, and private equity, affluent earners protect their capital against market volatility while maintaining a steady stream of passive income. To position yourself to reach the high net worth class as your career advances, you need to focus on expanding your income streams and optimizing your tax strategy. You can take actionable steps by shifting surplus cash into diversified taxable brokerage accounts, seeking out equity compensation or stock options in your company, and consulting with financial advisors who specialize in high net worth individuals. It is also vital to continuously reinvest your returns, allowing your capital to grow without drawing down the principal, which is the exact mechanism that propels individuals from a simple middle-class existence into the upper echelons of wealth. Part 4. The top 1% and the ultra-high net worth tier requirements. Reaching the top 1% of net worth in the United States requires crossing a substantial threshold, which currently sits at over $13 million for a household. This elite tier is vastly different from the ordinary millionaire category, because it is defined primarily by ownership and control over income-generating enterprises rather than dependent wealth such as a primary home or standard retirement plans. At this level, the bulk of a household net worth is composed of business equity, venture capital, and substantial commercial real estate portfolios that grow independently of the owner labor. The top 1% understands that wealth does not scale linearly through savings or simple investments, but rather transforms structurally through the creation and scaling of high-value assets and enterprises. Transitioning into the ultra-high net worth tier, which typically begins at $30 million and extends to the billionaire class, requires highly sophisticated wealth preservation and tax optimization strategies. At this elite stage, individuals rely heavily on microfamily offices, non-grantor trusts, and sophisticated estate planning mechanisms to shield their assets from massive tax burdens and to facilitate generational wealth transfer. Investment portfolios are significantly more diversified, yet concentrated on capturing high-yield enterprise value and tax-advantaged vehicles like municipal bonds or private credit. The focus shifts entirely from accumulating assets to ensuring that capital produces cash flow while remaining shielded from market volatility and inflation through legal and financial architectures. For those aiming to reach this tier or understand how the wealthiest individuals build and retain their fortunes, the actionable lesson is to focus on enterprise value rather than personal earned income. You must transition your mindset from being an employee or simple investor to becoming an owner or partner in scalable businesses that solve major problems at scale. You can take actionable steps today by analyzing your current career or business model to see if it allows for unlimited leverage, reinvesting your profits into business growth or productive capital, and building a team of specialized tax and wealth strategists who can help structure your assets efficiently as they grow. Part 5. Strategies and actionable steps to move up between wealth classes. Moving up between wealth classes requires a deliberate and strategic shift in how you manage, deploy, and protect your capital at every stage of your financial journey. For individuals starting at the bottom tier, the most effective strategy involves aggressively tackling high-interest debt while simultaneously building an accessible emergency fund. You can take immediate action by automating your savings, ensuring that a fixed percentage of every paycheck goes directly into an investment account or high-yield savings before you have the chance to spend it. By focusing your early efforts on reducing liabilities and establishing a consistent savings habit, you create the baseline momentum needed to cross the median net worth threshold. Transitioning from the middle class to the affluent high net worth tier requires you to change the way you view asset ownership and income generation. At this level, relying solely on your active labor or a single income stream will not provide the rapid growth needed to enter the higher wealth brackets. You must focus on acquiring income-producing assets such as real estate, dividend-paying stocks, and index funds that benefit from compound interest and long-term appreciation. Actionable steps include reinvesting your dividends, seeking out equity compensation in your career, and diversifying your portfolio across different asset classes to protect your wealth against economic downturns while accelerating its growth. Reaching the upper echelons of wealth demands a transition from being an employee or a standard investor to becoming an owner or partner in scalable enterprises. To cross the threshold into the top 1% and ultra-high net worth brackets, you must focus on building businesses or acquiring equity in companies that possess high operating leverage. This means creating systems and products that can serve a massive market without requiring an equal increase in labor or capital. You can take actionable steps today by analyzing your current professional trajectory or business model to identify scalability, surrounding yourself with experienced tax and legal advisors who specialize in wealth preservation, and continuously reinvesting your profits into productive assets to build a lasting legacy. Understanding where you truly stand among the different net worth classes is the most powerful first step toward achieving true financial independence and setting the right milestones for your future. Whether your immediate goal is to escape the bottom tier, reach the median national average, or build the wealth required to join the top 1%, the key lies in taking consistent, disciplined action and making your money work for you. If you found this breakdown valuable and want to continue learning how to grow, manage, and protect your wealth, make sure to subscribe to the channel so you never miss an update. To let me know that you are committed to leveling up your finances, leave a comment below with the phrase, "I am taking control of my net worth."